Hey, Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. This is a very dangerous situation in real life. Obviously, when you're dealing with military conflicts, that is not something to make light of. That is an actual situation. But for investors, we are going through a different, less serious, but still significant situation. Here's what you need to know. What you thought was going to happen is not occurring in the market, and we don't know when things are going to fix themselves, which means that your best move, which is what I said 2 days ago, your best move is to sit still. Sit down somewhere. If you got cash, continue adding cash to your account. If you want a DCA, I still think that makes sense. But what you don't want to do is panic sell because of days like today. We started off today looking like it was going to be one of the worst days of 2020. That's how bad it's been. It took me all the way back to 2020. One of the worst days of 2022. Got a notification, put that screenshot here, where it was down at 859 points, and then somehow we were positive. But here's the thing. Of all the companies that you think, and all the sectors, like what parts of the market that you think would have taken us out of that, what would have led the way, tech would not be on that list. It was one of the worst sectors this year, but it was the best sector today. You had companies like Microsoft, Google, Intuit, Adobe, all up between 4 and 5%. What? You had Roku. Roku was up 12% today, and like last week they were down 25%. None of that makes sense, and that makes it very, very dangerous for you to try to basically gamble and play the situation and be a very active investor and say, look, this thing is happening in Europe, and then I need to do this today and this tomorrow and walk out with a profit. That's going to be extremely difficult. However, if you've been watching for a while, I've talked about Adobe, I've talked about Intuit. For those who are in cram sessions, those are 2 companies we cover. We said it was get it, sit down, and just let it cook. And today, that tended to be right. We talked a lot about Microsoft, and we get it. We let it cook and not mess with it. We said this yesterday, right? If you've got quality companies, sit on them. Don't try to panic sell. You definitely don't want to do that. But don't try and say, oh, well, because this is happening, then oil's going to go up, so let me sell this and buy this and be very technical and very fancy. A lot of that stuff, chart reading, all that mess goes out of the window in days like today. Okay, I'm not saying that stuff can't be effective. It can be. But it is really, really hard to try and profit on days like today, when a lot of times you just sit back and mind your business. For example, when we talk about Intuit that was up like 5% today, I bought some on Friday because it was Friday and because it was my day to dollar cost average. Now it's up. Great for me, right? I don't have to sit here and guess, and that's the thing. You don't have to put the pressure on yourself because your Instagram timeline is doing it, or because your Twitter timeline is doing it, that you have to be doing something when the market makes these swings. You don't have to do that. Doing so can be very dangerous to people who are untrained and haven't done this for a while. And I'll give you a real life example where I almost got burned trying to be a little bit more fancy than what I usually do. Now, I'll give you a little bit of context and tell you what the actual numbers are and post those screenshots. So first, we're going to talk a little bit about options trading. Now, if you want a deeper dive into this, I did 2 videos on what options are a while back. So I should probably refresh those videos. I'll get to it at some point. But basically, an option contract says I'm going to lock in the price. Think of it like insurance for the specific stock. I get to lock in this price to either buy or sell at the price point that I want to get it at. For example, a call option says I get to buy Home Depot at 100, and if it's at 125, that's great for me. The value of my insurance policy, the value of that contract is higher because I get to buy low. My contract says I get to buy 100 shares at $100, and I get to sell it at whatever the market rate is. And if it's at 125, guess what? I've made a real good profit, right? So when stocks go up, call option contracts are one of the better ways to go if you're not going to own the stock directly. On the opposite side are put contracts, and a lot of people are talking about these in days like today, or at least half of the day, where the market is down significantly. You can make money when the market is down. And what I like most about it, one of the things I like most about it, is I don't have to deal with what I feel is kind of like the weird messiness of the market. Like, I could, profit, quote unquote, off of war and get Lockheed Martin or something like that. This doesn't make me feel good. You do what you want to do. But I can just get a put option on something like Ford. Ford ain't got nothing to do with it. Ford has been dropping. Is a great target, or should have been a great target on paper for a put option. Well, that's what happened, right? So I'm taking a look at something. If I want to get a put option contract, I want to make money when a company falls, a put option on a company that's been falling makes the most sense. Ford has been down like 16% in this entire month. Okay, so that's number one. And then this morning when I woke up, and I'll put that chart here too, it was down about 5%. So in my mind, in most people's mind, logically, right, the market is down 800 points. You got a crazy geopolitical event going on that's tanking the entire stock market for the last week or so. The company you're looking at is down double digits in the month, and it's down 5% today. What do you think would happen by the end of the day? You would think that the market or that company would at least continue to fall by the end of the day. That is not what occurred. In fact, Ford was positive. Ford was actually up 1.1% today. So here's what happened. I woke up this morning around, well, I don't know what time I got up, but by the time I got to my phone, I said, look, I'm going to enter into a put contract for Ford. Ford has been dropping. I own shares of Ford on public, so I know it's been dropping. So I said, look, I will buy a put option contract at 109. $109, bought like 4 contracts. So you'll see here where it says like 1.09, you multiply it by 100. It's how options contract works. I know. It can be a little confusing. However, paid 109 times 4, okay? As Ford continued to drop in the early hours of the day, let's say 9:30, 10, maybe 11 o'clock, the further that Ford dropped, the more money that this contract was worth. At one point, I think it was like $125 it was worth. So at that point, I said, look, let me put on a stop loss, okay? In case things don't go my way, at least I can walk out with some profit. I think I put that stop loss at like 115 if I remember correctly, okay? I was gonna walk out with at least that much money, okay? So 109 and 115, I was gonna walk out with that at least, right? And I thought, as I'm checking my phone every now and then, oh, contract is at 125, is at 150, whatever it was, I'm making some decent money. I go to lunch. I'll go downstairs and order whatever I ordered from DoorDash. I think I had some wings, which were really expensive because of inflation. But in either case, I come back, I get a notification, hey, you sold your contracts at 115. I'm like, wait a minute. What happened? How did I sell at 115 when I thought I was up by 61% or whatever it was at that point in time? Well, the market switched. And that's exactly what happened, which makes, again, why this is a dangerous situation, because no one would have told me if you start out down 800 that you're going to be positive by the end of the day. At no situation, at no point in time would I have thought that Roku was going to be up 12% in a day. And again, at no point would I have thought of all the sectors to make money that technology would have been the way to go. Which is again to say you don't want to get out here and start guessing and being ultra aggressive because of what the market is doing. A lot of people are coaching and telling people that, especially on social media, that this is the time to be active. This is the time to profit off the market. The market is moving. Everything's red. Do something. Do something. Do something. You don't have to. And you probably don't want to do that, especially if it is something that's new and something you haven't held before. If you already own a Microsoft, a Google, I don't know, a Walmart or something like that, and you just deciding to buy more like this morning or something like that, that's fine. That is totally fine. If you do nothing and you are still holding on to those investments, that's fine too. You do not have to get out here and be active every time that something crazy in the market happens. Tomorrow is another day. Now, I hope that it's not going to be as volatile. I don't really wish for these types of volatile moves, but in either case, if I spent all my capital today, I don't have anything for tomorrow, right? So again, my strategy is what I told y'all yesterday. I'm gonna sit still. I won't be doing a whole bunch of options trading, all kind of stuff, because that's not what I expected. I'm glad I made money. I'm glad I got out. What I'm not gonna do is get back and be greedy. Okay, you don't want to do that either. I got my profit, I'm gonna move on. Okay, so that's number one. But then also number two, if you got quality, which is what we always talk about here, if it ain't quality, we're probably not gonna talk about it, right? Unless I'm making fun of that particular company, or I'm telling you that, hey, this is trash. But in either case, I'm holding on to what I got. Tomorrow is Friday. I'm DCAing like I always do, except I'm keeping a little bit more cash. Normally, if I deposit, let's say $200, I am DCAing the entire $200. I will not be doing that this time. I'm gonna keep, I don't know, $75 or whatever it is to myself in that account for an opportunity to present itself. So yes, I still will be DCAing. I will make it a point to keep a little in cash so that when things smooth out, I can be more aggressive in DCAing in the future. You might want to take a similar approach. Don't let the market movements of the day, the headlines of the day, to run your portfolio. That ain't how it should work. You should dictate at what point and what price point you want to invest, and you need to play the market per se. You want to control your portfolio and control your finances, and don't let the market do it the other way. Because the market is going to do what it does, and it's down X%. And you do something, you say, oh, well, I need to hop into energy. Chevron was down 0.5%. You know, Microsoft was up 5%. I could have made 10 times more money on Microsoft today than I would have lost in Chevron. Don't make no sense. Shouldn't be that way on paper, right? Which is why, again, you don't want to be jumping and doing all that stuff. You didn't think Chevron was a quality company 5 weeks ago? Don't jump at it now, okay? If you thought Microsoft was great 5 weeks ago, sit with it. Stick with it and ride this thing out. I already gave y'all data yesterday about how these things tend to impact the market a year from now. Okay, that's what I'm really focused on, because I don't know what's going to happen tomorrow. I don't know what's going to happen in the next 2 weeks. We also don't know what the Fed is going to do now. This is one reason why a lot of tech stocks did well, because of the expectation, not reality, because I haven't seen nothing by the Federal Reserve where they said that they're not going to raise rates as aggressively. That is one of the reasons that investors are like, oh, well, tech makes sense because they're not going to raise rates the way we thought they would. That's a thought. That's not reality yet. We'll find out in March if that's the case. We'll find out if they release something. But as of today, we haven't. But the expectation in some of the investing community is they were going to raise rates by 0.5%. This is going to help quell inflation to a degree. It's going to help some companies. It's also going to hurt those who are not making money now. The thought was, well, because of what's going on, the market is tanking. Maybe they're not going to do a 0.5%. Maybe they do a 0.25% raise. That's going to be a boost to a lot of these companies that have been living off of loans, right, to push other businesses and grow their businesses. Well, that'd be great, I guess, if that were the case. We don't know that. Those are just hopes and dreams right now. So again, regardless of what the Fed is going to do, regardless of what's going on overseas, sit tight. There could be more volatility and even more opportunities for you in the future. But the thing is, you got to sit down and say, what are the quality companies that I've looked at, that I've researched, that I know are going to be fine? At what price points do I want to get them at? And then more importantly, if I'm going to DCA, can you do that consistently, and will you stick with that consistently? Because the key is, again, those who are going to be wealthy next year in 2023 are the ones who are consistent and have a plan right now. It's the exact same thing that I told y'all in 2020 and in 2021 when the market was even worse. It was actually 3 times worse than what it is right now. And I said that back then. Now I can look at my portfolios, looking a whole lot better than what it was in 2020, right? Because of the exact same things that we're talking about now. All right, so that is it for me today. If you've got any other questions, feel free to let me know in the comments below. All right, that's it for me. Talk to you guys later.